So yeah, this is happening. Just about every single software stock is absolutely tanking. And no, it's not because of interest rates rising. There is a valuation reset going on across the software space. And we're going to talk about what makes the most sense. Should we all run to mommy and daddy, cry about our stocks going down? Is this setting the precedence for something bigger, something greater? Is this a permanent reset in valuations? I have to disclose, I'm an engineer. Obviously, I'm biased to investing in technology, but in this video, there's going to be no BS. We're going to go through the facts that will hopefully shape our opinion on what the future holds. Is it time to panic, or are these fears overblown, which they usually are? So we'll preface it with that. So if you want no BS data, you came to the right place. If you want somebody to pat your back and tell you you're doing okay, buddy, you keep going, just keep buying as things are dropping, then probably go to another video. Let's get started. So first thing I want to do is validate the concern that people are having. We're talking about this SaaS apocalypse. What does that even mean? Well, very simply, right here, you're looking at a chart of technology stocks versus industrial stocks. XLK over XLI. Simple English. When this chart is going up, that means technology is outperforming industrials, a safer part of the economy, a place where boring investors go to get their returns, right? When this chart is going down, and frankly, it's absolutely tanking right now. Just to give you perspective on some of the companies in this ETF, they sell tractors to farmers. Raytheon makes missiles. GE Vernova is responsible for something like 25% of all electricity in the world. Boeing makes planes. Deere & Company makes more tractors. The point is, these are safer plays, right? Not exactly technology like you see with Nvidia, Apple, Microsoft. I think everybody and their mother knows about these companies. But the point is, this chart is validating to us that this SaaS apocalypse, this software sell-off, is very real. I mean, the rotation out of these technology stocks and into industrials is happening and at an alarmingly fast rate. Now, you're smart. You realize right away that it's not necessarily technology in totality that's getting absolutely creamed. We gotta dig even a little bit deeper than that. A company like Micron Technology, basically at all-time highs. Nvidia, yeah, it's off its highs, but it's certainly not tanking to the downside either. Vertiv just absolutely destroyed earnings and jumped like 25% in a day. These are all technology stocks, and they are at or near all-time highs. But then when we look at a stock like Salesforce, you can see this is ugly. I mean, we're at levels we saw 7 years ago now. So let's simplify all this. Let's put it into plain English. Why are software stocks selling off like it's the end of the world, like it's a SaaS apocalypse? This guy right here, Mark Benioff, he's going to be important, CEO of Salesforce. Why is Salesforce important? Well, we got to go all the way back to the .com bubble before software as a service was even a valid business model. We're going to call this era the prehistoric era of technology. Yes, it's dramatic. That's the point. All right, say we have a software company right here. Here's their little chimney. They're burning some logs for heat, I guess. This company makes software. Use your imagination. I don't care what it is. Maybe it's a software to train your dog or cat or something. The idea is they're going to sell to the consumer. This is you, the consumer. You have a dog or cat and you want to train this guy. You're going to buy this software from this company, and it's probably going to come in the form of a CD. You're going to pay a lot of money up front for this CD because you get lifetime access to it. You never need to pay again. That's the beauty of it, right? It's a one-time fee, so it's going to be expensive. You're going to plug this CD into your PC, and on this personal computer, you're going to consume this content, and then you're going to train your dog. You're both going to be very happy. Beautiful. The business model really goes something like, they're selling you a software that you can then download to your PC, and it's a one-time purchase. This is now a thing of the past. Why? There's a ton of disadvantages to this. Here's where Mark Benioff steps in and absolutely changes the game and basically propels software as a service, that business model, to become the golden standard going forward. So we're going to avoid all that crap that we just talked about by software as a service. www.dogtraining.com, they were getting sick of printing all those CDs. So you know what they said? They said, hey, let's get the cloud. What can we do with this cloud? That is ugly, but it's a cloud. This company bought a bunch of PCs, and these computers have all the information they need to run the software on the cloud. Now, instead of you up here with your little dog, right? Holy shit. Instead of you with your dog up here, you're not going to download anything. You know what? You're going to use your PC, your laptop, and use that software via the cloud. What are the advantages? Well, every time they have a software update, they can just keep pushing them along and you get access to the best software at all times. It's a win-win for both you. Scalability, I mean, you could tell your neighbors, your family, your dog walkers, whoever you want, you tell them about this and they can access this software as well. The company just needs to build out the infrastructure to handle all that bandwidth, right? And finally, the best part for both of you is the cost. You're going to be forking over money every, let's say, month or year instead of this really expensive upfront cost that's probably going to create a lot of friction between you and buying the service. If you only have to pay $10 a month, let's say, instead of a $250 one-time payment, you're probably going to be more likely to go with this route, especially because you can cancel at any time. This creates a business model that is extremely profitable, and you can see on average the profit margin at a software company is going to be much greater than, let's say, a grocery store or a company that needs to manufacture some electronics. It is the most profitable business model that has ever existed. So why are people selling it like it's some crap on the side of the road now? Well, here comes the AI agent. One of the biggest costs when it comes to a software as a service business model is labor. And when you have an AI agent that can do 10 times the amount of stuff, the amount of tasking that 5 software engineers getting paid $250,000 a year can do, all at a cheaper price, then I think you can begin to see why that software as a service model starts to fall apart just a little bit. But that's not the end of the world. These software companies can just fire people, right? If you fire people, you lower labor costs and hence your margins stay high. Good point. But what if other companies start to catch on and they recognize this? They say, oh wow, we don't necessarily have to pay $250 per seat on a Salesforce subscription. If we can just develop our own personalized software in-house with one human being using an AI agent for $20 a month. That means the potential market that you could address, the amount of sales you might be able to make, they're going down. So we're going to say sales are going down. That's not an opinion. That's a fact. A lot of companies are transitioning to having their own in-house solutions, buying using AI agents that can do, 10x the amount of work that some software engineers can do for cheaper cost in less time. Touche, you say. Mark Benioff, he's a smart dude. He's going to adopt this AI technology and then it'll be fine. You don't have to worry about anything. You just integrate it into your own software and you're good to go. Put an AI agent on top of it. Hell yeah, let's do it. Well, the problem with these AI agents is they cost a lot of money up front and a lot of money to operate over time because you need a lot of infrastructure to train and run these models. Now, if you're going to build out your own large language model for whatever your customized need is, then those juicy margins we just talked about, they're going to decrease. They're not going to disappear, but they're going to decrease in some way. Maybe that's significant, maybe it's not. It depends on the company and use case and how valuable your solution is. So margin, the difference between what you can sell your service for and what it costs you to deliver, that's going to come down because incorporating this is more expensive and not as high margins as a typical SaaS company would have. What's the bottom line? We have this pie right here, right? This is your 2025 revenue. Let's say you're Palantir, probably the fastest growing profitable software stock on the entire market. This pie of your total revenue is growing and growing fast. In scenario 1, you're able to bring home 75% of this pie. That's a lot of money. You're happy about it. Shareholders are happy about it. Shareholders are so happy, they're going to pay a pretty hefty premium to get some of this pie right here. In scenario 2, your margins get cut pretty significantly. Yes, your revenue is still growing very quickly. like you're seeing at Palantir. But because you're having to adapt to this AI integration, train your own models, inference from those models, it costs a lot of money. You're going to take it in the margin. You're not going to be as profitable. And if you don't adapt, then this pie, instead of growing larger, is going to grow smaller because other companies are going to eat you up and take your customers. So SaaS was a business model that frankly changed the world and how we interact with technology on a daily basis. The same exact thing is happening with AI agents right now. Are you going to adapt? Let's think of the best example I can possibly think of off the top of my head. It's Blockbuster and Netflix. I'm sure you remember Blockbuster. They had their little vending machines right outside CVS's and grocery stores. You'd go up to the machine, pick the movie you wanted to rent, take the CD home, watch it on your TV with your dog, and once you were done watching, you'd bring it back and return it. That's great. But then Netflix came along and said, hey, why don't we just do this all via the cloud? We could just have people rent it from the comfort of their own couches and homes. Let's just say Netflix ended up doing a little bit better than Blockbuster did over the coming years. Why does any of that matter? Well, let's wrap this up. Earnings per share or profit at a company. As that goes up, stock usually goes up as well, especially when you're a company that is growing those profits over time. Now, yes, things can get very far detached from reality. We see this all the time. Valuations don't necessarily indicate that a stock is over or undervalued. It's all relative to the time, to other companies in the industry, to the overall market, and arguably the most important thing is sentiment. When people are feeling really good about the prospects of SaaS companies, now they're growing margins, they're taking 75% of the money they generate to the bottom line. It's absolutely glorious. When things are going well and people are confident, let's just say people are willing to pay a higher premium for that stock. And we can see it definitely doesn't help. That sentiment right now is not great. I'm not going to go through exactly how this fear and greed index is calculated, but just know it's based on a variety of different things, like how bearish are investors positioned? Are most stocks moving higher, or is it just a few carrying the market? What does momentum look like? It doesn't really matter. The point is, sentiment isn't good. So when one, you have sentiment not good, two, the fundamental underpinning of what made software as a service the golden standard for a business model, highly scalable, low upfront cost, the best margins out of any business model to ever exist, all of those things are somewhat in danger, or at least impacted, at the very least impacted in some way, most of it negative, then we can start to see why companies that have this business model, software as a service, are absolutely tanking. Yes, they had high valuations, but they were growing really fast and had really good margins. Now they're potentially losing customers, bringing growth down. They're going to have higher upfront costs as they try to adopt this AI technology into their workflow, bringing margins down, and hence you get a business that's not growing as fast, and people are not willing to pay a higher premium. And they're already getting cold sweats thinking about what the stock market's gonna do tomorrow. So that doesn't help. Obviously, nobody knows for certain what's gonna happen. But if we look at some of the people who are the most influential in the space, let's say Elon Musk, maybe you've heard of him, maybe not. Either way, he's a pretty smart dude when it comes to technology, has a few companies worth over like 10 to $100 billion, whatever. He just said yesterday that maybe even as soon as the end of this year, you don't even have to code. AI just creates the binary directly. The AI can create a much more efficient binary than can be done by any compiler. In very simple English, you don't need software engineers coding anymore. Yes, maybe they can take over some other task like building a system, like optimizing user flow. Sure, there's other things to consider, but I think you could see why this could be dangerous to software as a service companies like, let's say, Duolingo. Duolingo, the world's most fun way to learn. Now you could create your own Duolingo that's especially personalized, customized to whatever is best and suits you in like a couple hours with a $20 monthly subscription with Claude or ChatGPT. People might opt into just making their own software that takes basically zero technical expertise. A lot of that number crunching that software engineers, accountants, and lawyers are doing, well, yeah, that stuff's gonna be fully automated in like a year and a half now. Expect entry-level jobs, those associate-level roles, to just be completely replaced by AI. That's not me saying it, that's the CEO of Microsoft AI, so take that for what you will. I think you can see it's starting to become an adapt or die moment, and that's exactly what the stock market's feeling like right now. So what's the takeaway from all this? Well, there's a massive sell-off happening, especially in names like Microsoft, like Amazon. We're starting to see it a little bit in Meta and Alphabet. The point is, investors are really scared of this CapEx. These companies are pouring basically all of the cash they generate as a business into AI infrastructure in the form of, for the most part, NVIDIA chips. We could talk about NVIDIA in a whole separate video. But at the end of the day, investors are really terrified of these numbers. What's to come? Are they overspending on this AI infrastructure? I think these A-list companies are probably the best buying opportunities. One, they're not as exposed to the software as a service collapse as companies like Duolingo, DocuSign, Salesforce. These companies have extremely sticky memberships. Nobody's gonna bail on the Microsoft suite or the Google suite. They have such a competitive moat still that I don't expect it to go away anytime soon. Microsoft could have some problems with OpenAI down the road, but right now it's probably a decent buying opportunity. So if these are like your A-list celebrities and these are your B-list, the B-list are definitely more heavily impacted, and that's already reflected in these massive tanks, right? Investors have been pricing in this stuff. Have they went too far? Maybe, but I think it is fair for a lot of these companies to be down pretty significantly. Lower margins, lower addressable market, those two things together compress valuations. People are nervous. If sentiment continues to be bad, then obviously these stocks are going to continue to tank off of a cliff. Eventually, they may get really cheap. A company like PLTR might be in a league of its own compared to these guys here. But the point is, companies can start to develop their own in-house software solutions in a couple days with a lot less people, a lot less payroll, and much less time. Is that always the best option? Well, no. If you need something that needs a high degree of fidelity and security, then probably don't just vibe code it out. CEO of Databricks, a pretty big software company. It's private, worth I think over 100 billion now. He says once the interface is just language, the products become invisible, like plumbing. Now again, this isn't completely true because obviously companies like Microsoft, like Google, like Amazon, like Meta, they have these very strong competitive moats. They have these massive databases, and there's a lot of friction to leave those platforms. You have all your data there. Why would you want to move it? It's a pain in the ass to move all that data somewhere else. But for companies who are still in their early stages and trying to grow and get new users, it might just make sense for someone to plug in a prompt that took them like a day to write and then have their personalized app up and running tomorrow that emulates, a Duolingo, let's say. Now, opinions are radically diverse, as always. You could look at like a million different pieces of data and come to a different conclusion based on every single one of them. But I'll give you two of them to conclude the video with. Short interest. Simply put, there's a lot of people shorting technology right now. Literally the highest level we've seen in 6 years now, higher than COVID. Should that make sense? Again, we talked about how it could make sense. Could this keep going higher? Yes, of course. This is more of a bullish take. A more bearish take, the dispersion spread is at the 99th percentile over 30 years of data. What the hell does that mean? Basically, the average stock is moving a lot, 10.8% over the last month, but the S&P 500 has barely moved. All the other times that's happened, it has been right before massive sell-offs in the market. Dot-com bubble, 2008 great financial crisis. Now, my opinion, I don't think the dynamic that's causing this dispersion is comparable to that time. This is more about investors repricing software. We used to pay 50 times earnings, now we're only gonna pay 30 because margins are coming down, growth is slowing, we already talked about it. The rotation away from software and into hardware is extremely evident right now. We have companies like Micron, SanDisk, Vertiv, all at all-time highs, and then companies like Salesforce who saw these levels like 7 years ago. So there's quite the dichotomy. Let's just say that. If you made it this far in the video, I really appreciate you watching. If this was interesting in any way whatsoever, consider subscribing or liking so you can give me some motivation to keep making videos. It helps. Trust me. Let me hear your take. Is this overblown? What stocks are you looking at, if any? Or are you staying away from software with a 12-foot pole right now? Best of luck. See you later.